Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is January 24th, 2012, and my guest is William Black, professor of economics and law at the University of Missouri-Kansas City, and the author of The Best Way to Rob a Bank is to Own One. Bill, welcome to EconTalk.
Thank you.
Our topic for today is bank fraud and what it can tell us about the crisis and what we might learn from it. Tell us, to begin with, about your background in detecting bank fraud.
It happened, of course, accidentally, like most things in life. I went over to the Federal Home Loan Bank Board in April 2nd, 1984, as their litigation director.
What is the Federal Home Loan Bank Board?
Well, it is two agencies ago. It was the primary federal regulator of savings and loans. It has a successor agency, the Office of Thrift Supervision, which has recently been killed by the Dodd-Frank bill.
And what did you do there?
Well, I did what the title suggested. I was litigation director, and we had independent litigation authority. So we didn't use the Justice Department. And so at a very young age, I had a docket of 10,000 cases and a budget for outside counsel of $100 million, which back in the day was a big deal. But pretty quickly, I became heavily involved in two other things, again, accidentally. We had a massive run on the largest savings and loan in America, American Savings, and it was a $6 billion run. This was not long after Continental Illinois had been brought down by a $6 billion run, and I ended up on the emergency task force, and so I was working with the business types and with the field folks, and supervision was really done in the field, not out of Washington, D.C. So I started learning a great deal about these institutions, and the head of the agency had undergone a remarkable transformation. He was a very, reasonably close friend of both of the Reagans, appointed head of the agency because of that personal relationship. Very strongly pro-deregulation, but he had changed by this point and had decided to engage in significant re-regulation. And because of a chain of random facts, I ended up being the staff leader of that effort. And it's a combination of those things that led me into the anti-fraud efforts.
Now, going back a little bit to that case you just mentioned, American, what was it?
American Savings, also known as FCA, Financial Corporation of America.
And
that was the holding company.
How was that after that run? How it was shut down? Is that correct?
No, and indeed that is part of this interesting story of fraud. It was a bit like Lehman Brothers, in that, as your listeners may know, the SEC and the Fed had people in Lehman in its final months of distress, and the Fed folks were from the credit side of operations. In other words, the potential lenders, presumably looking at collateral. And the Fed, knowing that Lehman was in desperate shape, sent two people. The SEC did as well, by the way. We, from our Federal Home Loan Bank of San Francisco, sent 45 people.
To look at American Savings.
To American Savings, and they worked around the clock in shifts going through collateral and made emergency lines available on the basis of reasonable collateral and actually survived a $6 billion run, but used that leverage to force out Charlie Knapp. And in this era, the folks were known as the high flyers, was the phrase within the trade, who were doing what was perceived as riskier things. And the perception about Knapp was that he was taking severe interest rate risk. In other words, growing very rapidly with a tremendous mismatch, investing very long-term in 30-year fixed-rate mortgages held in portfolio and financing them with very short-term deposits.
That sounds familiar.
Right. So the key difference is that the Federal Home Loan Bank of San Francisco used its leverage as a lender to force Knapp out and to bring in a new person. And that new person should, you would have thought, have saved the place because he immediately stopped the interest rate risk gamble, went to adjustable rate mortgages, not the modern kind in this crisis, but sort of good old-fashioned, fully amortizing adjustable rate mortgages. And so he minimized interest rate risk, and they had virtually no defaults on these loans. So you're thinking, this is great, right?
They're getting back to health.
Right. Wonderful intervention, brought in new folks, saved the place. And what turned out was every quarter the place lost money. And so this made no sense. And what we discovered eventually when employees started coming forward was that they had missed entirely the major operation, which is what we call cash for trash. And when I say we call it as regulators, that's the phrase the industry used to describe it, and we simply adopted their phrase.
Now, when you say they discovered, what you said they missed, when you said they, who was they?
Yes. In this case, it was everybody.
Okay.
So the Securities and Exchange Commission had prompted the run. I'm not blaming them, mind you. This is a good thing. But they prompted the run by finding a case of accounting fraud by American Savings and forcing it to restate its earnings. But they didn't find the underlying larger fraud, they, the SEC, nor did the investors, nor did the regulators.
Okay, and what was that fraud?
And that fraud, as I said, was called cash for trash. And cash for trash works this way. So Charlie Knapp didn't simply grow rapidly. He made extremely high yield, high risk loans, particularly commercial real estate. And of course, as you might expect with a guy like this, these loans were frequently bad. And that, of course, would have caused tremendous loss recognition. So you come into American Savings, and you've never developed anything. You say, I'd like to borrow $1 million to create a strip development, put up a 7-Eleven. And the American Savings person would respond, the lender, loan officer type, sorry, we won't make you $1 million loan, but we will make you an $80 million loan.
To a person who's perhaps never developed anything substantial ever.
Yes, indeed, that would be the norm, and it would be the norm for good economic reasons, because if you're a real developer, even if you have no financial stake in the project, it's a non-recourse loan with no down payment, you still have a reputational interest that can get in the way of what I'm about to describe.
Okay, so this by the way, is going to be symptomatic of a much larger problem. So for those of you listening and you think we're delving into this particular case of American Savings and this peculiar kind of weird transaction, this turns out to be kind of unfortunately, a template for a wide variety of behavior. So carry on. So I walk in.
That's exactly right.
So I'm walking in.
Key recognition.
I'm walking in. I've never built anything in my life. I come to you, American Savings. I say I want to build this development, and I know and you know it's a loser. The place I want to build, it's overbuilt already. I don't have much of a track record. And your point is that if I did have such a track record, I wouldn't be so eager to build a lousy development that would hold me back because I want to keep doing this. But if I'm a one-time kind of guy, I walk in, I want to borrow $1 million. You say, oh, no, we're going to lend you 80. Why would that be a good idea?
Because I would have previously have made a loan for $60 million to somebody else. And they would be actually meet your description even more of the deliberately putting up a building that made no sense. And, of course, it would have gotten into trouble. And so the pesky examiners might be either have come in or you fear they're about to come in and say that the $60 million acquisition, development, construction, what's called ADC loan, is really only worth $30 million, and you have to recognize a $30 million loss. And, again, foreshadowing many things we'll talk about, all of these entities have virtually no capital in reality. So a $30 million loss is an amazingly big deal.
Yeah.
A few of those, and you're gone.
I'm gone, right.
Right. So I don't want to recognize that loss. And so when I do this with a class, I ask, so what do you do? And after a lot of prompting, they'll say, well, I loan this new guy, the one that comes in, that wants to build the 7-Eleven, $60 million. And he buys it for $60 million. And that's the C- answer. Because what you're really going to do, of course, is buy it for $78 million.
So I'm lost. I'm sorry, I got confused there. So you've got a project. You're a bank. You've got one project. You've already that went sour. It wasn't. You didn't plan for that one to go sour. It didn't turn out right.
You didn't care. You were fairly indifferent to it going sour.
So all of a sudden, this stream of payments that you might have gotten is now not going to show up. And you're going to end up with a major loss on your hands. You're going to have to grab the property in this half-built building maybe or building that's been built but it's empty. And the guy says, sorry, I can't pay the loan, but I guess you'll take my land and my building, right? That's
right,
the first thing.
Except that there has never been a stream of earnings.
Okay, right. There's nothing. You've never rented a single office in the building. And now I come in, I'm the second guy, and I say, I want to build a 7-Eleven. I want to borrow $1 million. And what do you do?
I loan you $80 million, and you keep $2 million as walking away money, which is again what it was called.
So you're going to give me $80 million.
Yep.
I'm going to take $2 million of it to pay my salary as developer of right. Yes,
for the risk exposure of committing this fraud.
Yes. And what's going to happen? What am I going to do with the other 78?
I'm going to purchase the building.
Wait a minute. You or me?
The 7-Eleven developer.
That's me. Sorry.
I'm sorry. You are going to purchase the big office building.
Oh, I'm going to use my $78 million that's left over to overpay for the bad thing you already built?
That's right. And I transform in my hypothetical, which is not a hypothetical, a true $30 million loss. You had an original book value of $60.
And now you got an $18 million profit.
And you would frequently have what was known as the lender, American Savings, would frequently have what is known as an equity kicker. And an equity kicker would mean that you would get 50% of the net profits if there was a successful sale.
So, but how do I? That's really ugly fraud because I'm supposed to, right? Because I'm supposed to take the 78 you gave me and build the 7-Eleven. You say I'm not going to do that?
No, you come in for a 7-Eleven. I say I tell you forget the 7-Eleven project.
Okay,
that's not what we're going to do. You are going to get an $80 million loan. And you keep $2 million of it as walking around money.
And I take the other 78, overpay for your lousy project, and then you then to the regulators and your books, you say we made profit on that first project because we sold it. We sold it to a guy we lent the money to actually, And, of course, I'm going to default on the $80 million loan now.
Eventually, but I'll refinance it 3 more times.
And so what you've done there is you've pushed the day of reckoning down the road with no hope of ever having it be positive. And in the meanwhile, I've made $2 million. You've made the equity kicker for you've pocketed some bonuses maybe and compensation for a good quarter because you had a big profit. Is that the idea?
Yes, and I have transmuted a real economic loss into a fictional gain. Remember, the pesky examiner was about to force me to recognize a $30 million loss, which threatened my ability to survive.
And now,
so when these frauds are dealt lemons, they don't make lemonade; they make Dom Pérignon.
It's a Ponzi scheme, essentially, right? It falls apart either when you run out of. Well, I was going to say when you run out of people unwilling to participate, but there's always. Does the person who takes the $80 million loan and pockets $2 million does he go to jail?
Eventually, in the old days, yes. In the current system, no.
And he goes to jail because he has willingly participated in a sham transaction. What's the illegality of what he did? What I did in that story?
Yes, excellent question. What you did, because back in the era I'm describing, we had actual rules.
Yeah.
And the actual key rule that helped make these prosecutions was very simple, and it was one of those rules that economists could love. Libertarian economists could love.
That's me, Bill. You know that.
It said 3 things. 1, you must underwrite a loan before you make it.
What does that mean?
Well, it doesn't do you much good if you underwrite it after you've already dispersed the money.
But what does it mean technically to underwrite the loan?
Underwriting is the process in this context of determining the risks of the loan, whether it should be made under your risk views as managers, and what the necessary yield is, the required return in our jargon.
So this is like it's an assessment. It's the due diligence before you make the loan that complies with your regulatory framework.
No,
is that correct?
This is the due diligence that you would do if regulators had never existed.
Oh, just the idea that you'd want to know what's going on.
Yeah. In other words, so to back up, if you don't do due diligence or underwriting in the lending process, we have known for centuries that you create acute adverse selection.
Sure.
And in the context of a mortgage loan where the money goes out at the beginning as opposed to credit cards where it goes out in tiny slugs, to engage in significant adverse selection in the mortgage context is to create as a lender an intensely negative expected value.
And by adverse selection, you mean you're going to draw people who are bad credit risks or just going to be happy to live in the house for a while and then lose it.
Yes, in this context, you get the worst possible borrowers, and because you do not know the risks, because you have not looked, you will underprice.
Okay, so let's get back to your sequence. So you have to underwrite the loan.
So you have to underwrite the loan before you make it. Second thing is you have to, through the underwriting process, establish that the person has the apparent ability to repay the loan.
Yep.
And third, you have to keep a written record of this process.
Those are pretty simple. Now, the puzzle, of course, and we're going to come to this when we talk about the current crisis, the puzzle is, so why would anyone lend that money, right? Why would I ever want to create a set of loans that would never pay off, that I know in advance are likely to not pay off?
Because as Akerlof and Romer put it aptly in the title of their key article in 1993, Looting the Economic Underworld of Bankruptcy for Profit, accounting control fraud is a, quoting them again, sure thing, unquote.
Well, it's sort of, and the sure thing there is the sure thing that's with the Ponzi scheme, right? If I if I have a bunch of sham investments that I finance by continuing to roll over and attract new investors under a promise of a particular rate of return, say, it's a sure thing until it's not a sure thing, until I can't find those people anymore in the case of a Ponzi scheme, and then I lose all my money and I go to jail. In the case of a bank, this works for a while. I live a good life in the meanwhile because I've got a lot of cash to play with that I can pay myself with. I've got to be attracting money somewhere along the way. So I'm attracting deposits, say, which I'm using to finance these sham transactions and skimming off chunks for myself and the people I lend the money to. But eventually, there's a day of reckoning. So it's not a very attractive sure thing. It's a sure thing until you get caught, and then you go to jail. Only if you go to jail.
And as many economists aptly said, again, it's like all things in risk. You have to make forward-looking views.
There's uncertainty.
And at times people were doing this, nobody was going to prison for these things.
In the 80s, you're saying?
In the 80s, and of course now, they most assuredly, if they're the elite managers, don't go to prison. In fact, they don't even get investigated in the modern era, much less prosecuted, much less imprisoned.
So let's go deeper into looting. You just gave us a scenario where...
right. You asked me to explain what the crime typically was, and that's why I was explaining the underwriting process. We are back to you, where you are the straw purchaser.
Right. I'm the straw developer.
Okay. And the crime is that for an $80 million loan, you're almost certainly going to overstate your income.
Oh, I see. There's going to be a literal fraud. It's not just that I'm faking it and pretending to be a developer. I'm going to have to have filled out some paperwork that shows that I'm not who I said I was.
And that's because we, in that era, had rules requiring this underwriting. And again, the key on those rules is we didn't go to best practices. We went to minimal practices that any entity that was going to survive as a lender would use. So they were pretty close to zero economic costs to this regulation. But it created a problem for you if you were to engage in fraud. And so what you would typically do is either put false information in the files or remove honest information from the files that would demonstrate to the examiners that you knew you were making a bad loan.
And that would clearly be the case on my side as the borrower. And on your side as the lender, you would go to jail for knowingly accepting false documents or removing those things from the file? Or
you would have been the person, just as in the current crisis, who would be encouraging and in many cases preparing the false financial statements.
Yeah.
You're not going to leave it up to the unsophisticated person who's never been a developer to get the
figure out what he needs to lie about. Yeah. So let's take a brief digression here on ethics, a topic that is rarely rears its attractive head. You said in the profession, this was in the industry, this was known as cash for trash. And at that point, people didn't foresee that they would some of them would go to jail for this procedure. It's not a very nice thing. It would sort of, when you went home at night and talked to your spouse, you'd kind of feel, how was your day? Well, I made another lousy loan. It's doing great. We're going to Tahiti this summer for a month. How did this become the norm? And it was the norm. This is not like we're talking about one particular example, but there were many, many banks. In the Romer paper, I remember the Akerlof and Romer paper, which we'll put a reference to. It's a very important paper. This wasn't like an isolated thing where someone said, hey, maybe I could get away with this. It was widespread, correct?
Yes, the inevitable National Commission to investigate the causes of the savings and loan crisis. The famous phrase is, at the typical large failure, fraud was invariably present. Now, that's the norm within the large failures. That doesn't mean it was the norm within savings and loans. There were 3,000 savings and loans, roughly, depending on the exact date, and we're talking about 1/10 of the industry. But 1/10 of the industry is enough to cause catastrophic losses.
And of course, those losses continued to mount. Let me see if I can get the chain correctly. So I'm a savings and loan. I'm attracting deposits by offering nice rates of interest. I'm taking the money, lending it out along the lines of what we just talked about, aggressively, having good quarter after quarter by this, what again seems to me like a Ponzi scheme. And the people who are ultimately financing it, although they look like the depositors, are not really the depositors. It was the taxpayer who, because the S&Ls were FDIC insured, the taxpayers were ultimately the funders of this fraud. Is that a correct way to describe it?
Well, first there was a separate insurance fund in those days, the Federal Savings Loan Insurance Corporation, as a technical matter. But yes, the government was behind most of it. But don't forget, in terms of key stuff about moral hazard, the government wasn't the only entity. There were shareholders at most of the worst places, and there was subordinated debt at many of the most fraudulent places. And of course, in economic theory, it was supposed to be subordinated debt that was the perfect form of private market discipline.
Right.
You had the right incentives, you had the sophistication, and you should have done something, but there were 0 cases of effective private market discipline by either shareholders or sub-debt holders in the savings and loan crisis.
Let me just review that and we've talked about this in passing in many, many different podcasts, many episodes of this show. The debt holders have a fixed upside. They cannot make more than they're promised. Their downside is being wiped out. So in general, they are going to be the watchguards of risk-taking and the enforcers of prudence on the part of the people who they've lent money to through this debt. And what I have been worrying about for a long time, and it's a worry I learned from Gary Stern's work, is, well, that's true that under a market system, the debt holders are supposed to be the disciplinarians of risk-taking, the watchdogs. But if the bondholders think that they might get their money back even when the firm goes out of business, which happened with Continental Illinois in 1984, you might start to not worry so much about that and be willing to accept a fixed rate of return even when there's a chance that the investment will amount to nothing, because you might get your money anyway. Correct?
True, but not basic enough. In other words, you're quite right that Continental Illinois did a terrible thing, and it bailed out sub-debt holders. We never did that in the savings and loan. We always wiped out the sub-debt holders, and of course they're supposed to be wiped out. That's the concept of risk capital. Despite that, there was never effective private market discipline. Indeed, there was no even effort at private market discipline that failed by sub-debt holders during that entire crisis. And what I'm explaining with this sure thing and the creation of this record-reported income hits the Achilles heel of the theory of private market discipline. So in the real world, if you're the CFO of Enron and you're reporting record profits, your problem isn't private market discipline. Your problem is that bankers are almost literally trying to break down your office door to get into you to lend you money. So as long as you're reporting record earnings, it turns out private market discipline is an oxymoron. The primary entity that loses money, as you aptly pointed out in the savings and loans, is not the shareholders. because of the very thin equity. It's the creditors. Now, in the savings and loan case, yes, the ultimate creditor was the government in most cases. But that's not true of the Enrons of the world. That wasn't true of the Bear Stearns, Lehman Brothers, Merrill Lynch. They were in other words, the entities that fund the accounting control frauds are overwhelmingly the creditors who, in theory, are supposed to be the ones providing discipline. Instead, what they mostly do is provide cash.
Right. So that's, again, the puzzle is why. And the answer, it seems to me, is that there's two answers. One is they looked at the record profits, the good times, and they were lulled into thinking that they would persist. I find that explanation unpalatable and probably false. Of course, it's possible. It's possible that there's this animal spirits of exuberance that gets out of control. But these are savvy people. They've seen a little bit of the world. They do know that prices can go down and assets do fall in value from time to time. It's hard to – and in fact, each of these firms had people in them, and that was their sole job, was to worry about that and tap the other people on the shoulder and say, oh, don't forget. And yet they persisted. They continued to fund those investments, and eventually when they weren't turned out badly, they should have been wiped out, but they weren't. They got 100 cents on the dollar. They were totally insulated from the market discipline that should have been in place.
Well, it depends on what you're describing. That's certainly not true in the savings and loan.
Correct. I'm talking about the current crisis. I'm talking about the Bear Stearns creditors. I'm talking about AIGs. I'm talking about Merrill Lynch. Everybody except Lehman. The people who had funded the daily operations that provided that the liquidity that let them make the bets they made were insulated from the failure.
Well, again, if you go a little farther back, because again, this theory says, what do I anticipate? We had not been bailing out investment banks, and investment banks had been failing, and by the way, they failed primarily because of fraud. And there were no bailouts. So if you go on what people supposedly would have been anticipated coming into this crisis, I don't buy the argument that they would have been very sure that they would be bailed out. The banks that facilitated Enron's fraud suffered significant losses, for example.
But the banks that funded the escapades of the Mexican government in the mid-'90s suffered no losses because the U.S. government stepped in using the same argument they would use in this crisis, that there was risk of global instability, that Mexico could not default, no one needs to take a haircut. The U.S. government will guarantee the bonds that the Mexican government would issue to cover its past promises, and it turned out they didn't lose a penny. So it turned out great according to the defenders of that policy. But the investment banks that had bought those Mexican bonds, that had issued those, had underwritten those bonds and been part of the stream of income that they generated, they were made whole. And I think that's part of the problem.
I agree that is part of the problem. I would, again, say they weren't really made whole, except in a very nominal accounting sense. In other words, there were real losses suffered, and Citicorp was next to death's door in a number of times. But I think where we all end up agreeing is the treatment of systemically dangerous institutions that allows them to hold our economy hostage and produce these bailouts is completely destructive of almost any view of how an economic system should run.
So we're going to agree on that. So let's get to how the story you just told me about American savings, that in that era of the savings and loan crisis, when banks realized that actually, let me ask you a different question before we get to the present. How do you get to a world – wouldn't you rather make good loans? So why would you run around trying to make bad loans, and why wouldn't that In other words, why then? Because you'd think, well, okay, if this is a good trick, you should always do it. If it's not a good trick, don't do it if there's a better alternative. Why was it prevalent then? What kicked that looting off?
Well, what kicked it off was almost certainly the first phase of the savings and loan crisis, which had nothing to do with fraud, was the interest rate crisis. And, of course, the entire industry ran on a system that exposed it to massive interest rate risk. Volcker decided to break the back of inflationary expectations, created the double-digit interest rates, and every savings and loan in America was insolvent on a market value basis. And collectively, by mid-'82, of course, this wasn't realized for accounting purposes, but in real economic terms, the industry was insolvent to the tune of roughly $150 billion.
So at this point, I'm running a bank, and I have made a bunch of – we did other podcasts on this. We'll put links up to on the savings loan issue. But basically, the idea is that I have – to attract new money, which I need, I have to offer a large interest premium. But the money that's coming in from my old loans is very low. So this is the mismatch problem, correct?
Yes, although this is where the conventional economic wisdom turns out to be highly incorrect. But it does create lots of pressures, and it creates a unique political opportunity. So the head of the Federal Home Loan Bank Board at that point is Dick Pratt, an academic, very conservative, very libertarian economist / finance expert. And he creates the key deregulatory bill. Indeed, it was known as the Pratt Bill informally. It becomes the Garn-St. Germain Act of 1982. And being a good economist, he tries to do it exactly right. And so he asks his economists at the agency, which of the states has the best results, right? So this is Brandeis-like laboratories of experimentation. And they come back and they say, Texas. Texas is the place where the savings and loans are reporting the best returns. And so he uses Texas as his model for deregulation in what becomes the Garn-St. Germain Act of 1982. The problem, of course, that he and his economists didn't understand is that the Texas savings and loans were doing what we have been describing in this podcast.
They were market leaders.
Yes, they were the market
They're innovators.
And as a result, they produced over 40% of the total losses in the entire savings and loan crisis. And this is the fundamental problem with relying on econometrics during the expansion phase of an epidemic of accounting control fraud, because you will inherently get not just the wrong answer in terms of policy, you will get the worst conceivable answer.
Yeah, it's a destabilizing feedback loop. So,
right.
so what is, I think, trying to answer my earlier question, this kind of looting or control fraud occurs when I realize that my bank's dead, that my assets are worth less than I had thought or less than I expected. My liabilities are greater than I expected, and it turns out they're much bigger than those assets. I realize that my bank is shot, and if an honest and diligent set of evaluators came in, they'd realize this also, and I'd be shut down. Instead, I cover up that bad situation with the kind of behavior we talked about earlier, which allows me to sustain a personal lifestyle and set of a package of compensation that's very attractive.
And it's a sure thing, and no one's getting prosecuted. But here's the kicker to what you just said. That describes 100 shops out of 3,000. So back to your point about ethics and sociology, right? Mores. If you had been a CEO, these things come from the C-suite. and you had worked at the savings and loan for 30 years, and you'd risen through the ranks, and you'd hired pretty much everybody who worked at your shop, this is a much less attractive strategy.
Yeah, you've got friends. You're in the community. You don't really want to have people pointing to that grotesque bad development and say, "Oh yeah, he did that." Right?
That's right. You're proud of your place and you identify with it. And so, in fact,
most people didn't do that.
Extremely unusual for these folks, even though it appeared to be a sure thing. And so the Larry White, this is the NYU Larry White as opposed to your colleague?
Yes.
Famously writes about this episode, and he was one of the presidential appointees running the Federal Home Loan Bank Board for several years, saying the mystery for an economist is why there was so little fraud.
Yeah.
Right? Not why there was extensive fraud.
I understand. So you can debate whether...
the key is entry.
Yeah. Is 10% half empty or half full? Yeah. Go ahead.
No. But the key is entry, which is a wonderfully fine traditional economic concept forgotten by economists in discussing this crisis. So the fraudsters, grossly disproportionately, are new entrants. And they are overwhelmingly real estate developers who have,
funding
of course,
themselves.
Intense conflicts of interest.
Yeah, funding themselves, yeah.
That's right. And they are frequently crummy real estate developers for the reasons we've discussed.
So they put out a shingle, start a bank, start collecting some deposits, start lending themselves money for projects that aren't going to make it. And their depositors, of course, are going to get their money back as long as they're not too large. And even if they are, sometimes they do anyway. Okay, let's move to the present or the semi-present. Let's get up to 2008 and go forward. And I want to talk about, if we can, Fannie and Freddie and the investment banks who were doing all of them were doing something similar. They were generating they sometimes on their own, in the case of investment banks, through their own mortgage origination shops. In the case of Fannie and Freddie, they couldn't originate loans. They could merely finance them and fund them and buy them. But both these groups were grabbing up mortgages, packaging them into securities, and selling those securities often to each other, often to pension funds and people around the world. What's the parallel between that period of, which is really roughly 2003 to 2008 when it totally fell apart? What's the parallel between that period of financial activity and the stories we've been telling?
Okay, so what we hadn't finished the logical link is deregulation in the savings and loan crisis. The key event that is so fraud-friendly in terms of creating a criminogenic environment occurs in 1982, and re-regulation begins in 1983. So it begins very quickly, and therefore it's done in the face of unbelievably intense political pressure from both parties. So that's a completely distinct pattern. Now, to understand the current crisis, you actually have to go to 1990, 1991, because that's when liar's loans become significant. And as with all good fraud schemes in America, it begins in Orange County, California. And it begins in large part at Long Beach Savings. And we are the regional regulators by that point.
Who's we?
We are the Federal Home Loan Bank of San Francisco, and then it becomes the Office of Thrift Supervision, West Region. And we go and we look at it and we say, wait a minute, you're not going to do underwriting, and that's going to produce immense adverse selection. You're going to have a negative expected value. You have to lose money doing this. This is insane. This can only make sense as a fraud scheme. You can't do it. And so we use normal supervisory means to wipe out liar's loans among savings and loans in Orange County in this era. Whereupon they, of course, they being Long Beach Savings, give up their federal charter, give up federal deposit insurance, and become a mortgage banker for the sole purpose of escaping our jurisdiction. And they change their name, and they become AmeriQuest. And your listeners who are familiar with the story will recognize that name because it is the first big and infamous maker of liar's loans and other non-prime loans. And on top of that, it's a predatory lender that aims at minorities. Whereupon they, after we crack down on them, and by the way, the leading competitor are two people, a husband-wife CEO team at Guardian Savings that we had removed and prohibited from the savings and loan industry, so they simply went to mortgage banking, which is essentially unregulated.
At the time.
So that's where you have this era in 1990, 1991, in which you get hundreds of millions of dollars of losses from these loans. But they are pushed out of the regulated industry. There are 2 more crackdowns, including 49 state attorney generals, plus the FTC suing AmeriQuest. They settle for $400 million, which at that time was a large amount of money. And we promptly make the CEO of AmeriQuest our ambassador to the Netherlands.
What year was that?
Because, of course, he's the leading political contributor to the President of the United States.
Strangely enough, he has a lot of friends.
He had a lot of friends.
What
he
year
actually had friends again in both parties.
Yes, no doubt. Just like Countrywide did, and
yes, they all
and Fannie and Freddie.
Away to anyway. So that's what happens. Is overwhelmingly this stuff gets pushed at first out of the regulated entities. And so it becomes the mortgage bankers, and the mortgage bankers almost exclusively for the first 8 years are dealing with the investment banking firms, the big 5.
But I'm confused now. So in early 1990s, there are some firms who are lending money to people who are not accurately representing their ability to repay the loans, right?
No.
What's a liar loan?
A liar's loan is, you're correct, involves false statements about income, but it is not the borrowers. It is overwhelmingly the lenders for the same reasons as in the savings and loan crisis.
Well, that's what I don't understand. So I'm AmeriQuest. I'm Long Beach to start with. And I am lending money. We're reversing roles here now, Bill. It's going to be, let's see if you and I can handle it and the listeners can handle it. I'm Long Beach. You have a modest income. And you come to me and you want to buy a house, and I say, no, you don't want to buy that house. Here's a bigger house, and you say to me, oh no, but my income, I can't afford it. No, don't worry, I'm going to lend you the money anyway, as if you had the income of 4 times what you actually have. Is that a liar's loan? That
is a liar's loan, but that's not the most typical way that it's going to occur.
Okay, tell me how it's going to occur.
The typical way it's going to occur first is through a broker. So yet another party has to be introduced to this.
Go ahead.
So to skip through, there's testimony in front of the Financial Crisis Inquiry Commission that it was common for the prior job of the mortgage broker to have been literally flipping burgers. So I'm the lender. I'm sorry, you are the lender, right?
Yeah, sorry.
We're doing this. You're Long Beach.
Yep.
You make the following deal. And, of course, you don't have to have a discussion. You just send out your daily term sheet to starting out with hundreds, but eventually tens of thousands of brokers. Communications. It got cheaper. And the term sheet says it creates an optimization thing, right, that has 3 components. 1, higher yield good. you get a higher yield as a broker. I give you a bigger fee.
Okay.
2, and lower loan-to-value ratio. Very good. I give you a higher fee.
So I'm the lender. I'm telling my brokers, don't ask for much money down. Charge them a high interest rate. And what's the third? Is there a third piece?
No. You missed. It's actually the opposite. A lower loan-to-value ratio. So I want to make it look like
Yeah.
there's you've done a lot.
Oh, sorry.
And also a lower debt-to-income ratio.
Okay.
All right? So those are the 3 things that we're optimizing.
Okay, go ahead.
As a loan broker. And to skip forward to the current crisis, as you know, home prices in California are often very high.
Yeah.
And so for what we call a jumbo, a $600,000 to $800,000 range, you could get, as a mortgage broker, a $20,000 fee for one jumbo.
To bring me the loan that the borrower that I'm going to make the loan to. You're going to get $20,000.
So you want to incent people to bring you these loans in extraordinary volume with the ultra-high yield and then these 2 ratios gimmicked to make it look like the loan is safer. And the reason, of course, is you're going to resell this loan.
Yeah, who am I going to sell it to in 1991? That's what I'm wondering about.
Oh, we're going to sell it to Lehman, and we're going to see all of the investment banks had a non-prime entity, at least one non-prime affiliate.
Well, they had their own mortgage originators, too, in the non-prime world.
Well, sometimes.
Well,
They most frequently did exactly what I've described here. So Lehman Brothers, Aurora actually had very few loans it made itself, but it made hundreds of thousands of these loans through the brokers.
But this is the puzzle. This is what I'm confused about. This is not 2003. You're saying this is 1992. How does Long Beach Savings make any money at this? You're saying because they're selling them to investment banks? Why would they buy them? They're lousy. It's a
sure thing.
Well, that's what I don't get. How does this relate to the earlier story where there was a Ponzi-like scheme that let me sustain an unsustainable situation for a while? Why is this a good business model in 1992?
Okay, so let me tell you the fraud recipe, and for both a lender and a purchaser of these. So for a lender, it's got 4 ingredients. Grow like crazy by making really crappy loans, but at a premium yield. And those first 2 things are related.
But yield.
With extreme leverage.
Okay.
And virtually no meaningful allowances for the future losses being recognized currently.
So how does Long Beach do that?
Through this loan broker process that I'm describing. So I told you the first 2 elements, the first 2 ingredients are related. I would, of course, love to grow exceptionally rapidly by making really high-quality loans.
But there aren't enough to go around.
Not only that, but this is a mature market. This is not like iPads. And it's a very competitive market. And so what happens, let's do the thought exercise. I want to grow 50% a year, which, by the way, is what was the average of the accounting control frauds by savings and loans until re-regulation. The average one was growing 50% a year. That's exceptional growth, as you know. All right. So if I'm going to grow 50% a year by making extremely good quality loans, what do I have to do? I have to buy market share. How do I buy market share? I have to cut my yield. But in a relatively competitive marketplace, what are my competitors going to do? They're going to chop their yield. Yep. So at the end of the day, is this a good way to create nominal income? No, it's a terrible way. You obviously destroy nominal income through that process. But there are tens of millions of people that cannot afford homes.
They don't have the down payment. They don't have the credit record. They don't have enough income.
That is correct.
So
and
I go to them.
I have a huge number of folks that I can lend to. And here's what's even better. As we often have to spend a lot of our time with students explaining the fallacy of composition, that a strategy that's good for one entity can't work typically for an industry. Right? If we all try to sell at the same time, the classic example of portfolio insurance, it doesn't work really well.
Okay, so go ahead.
Okay, so, but the fallacy of composition works the opposite way when a bunch of us make bad loans. Because it turns out there are better places to make these loans. And that's going to be a combination of ease of entry, which assets are better for inflating values and hiding real losses, where is the risk of prosecution the smallest, et cetera, et cetera, et cetera. And therefore you get clustering. And you get emulation, what Akerlof and Romer talk about, the mimicking process.
So in that world...
It's an easy strategy to emulate, right? Grow rapidly by sending these term sheets out to brokers.
Okay, so
anybody can do it with no brain.
Okay, but I'm Long Beach now, and I realize that if I want to have a big institution, I can't just compete like everybody else. I can't just go to the good credit risks. I have to start lowering my standards, lend to people who are not normally going to get a loan, who don't have the income, don't have the credit rating, and I start offering them loans that are that normally wouldn't get made. So I have two questions. And one is, why do I do that? And is the answer because I'm going to look like I'm generating? Why is that good for me as the executive of the bank? How am I looting where's the looting?
Sure. So I create three sure things to, again, adopt Akerlof and Romer's phrase. The first sure thing is if I follow this recipe, I am mathematically guaranteed in the near term to report not just good profits, but record profits, off-the-chart profits. Two, with modern executive compensation, I will become wealthy. And three, if you think about that recipe, I'm actually maximizing real losses, real economic losses.
So where do I get the money from to fund this escapade?
So what they had to do,
because the money's got to go out. This is not quite like the earlier story, right? I've got to give money to people who are going to use it to buy houses.
Without deposit insurance, it is harder to hold it in portfolio. You should not assume it's impossible, and Ireland should be your cautionary tale, where there was essentially no secondary market, and they did very similar things. Because it turns out you can expand, even in the Irish context. Okay, but back to your point. So how do they get the money? And so they had an originate for sale model. Now, as you've said, they are selling overwhelmingly to purely private parties. And neoclassical theory says it's impossible. They will exert private market discipline.
In theory.
Right. But we ran a real-world test of the theory. And it turns out folks not only will buy it, but they will eagerly buy it, and they will expand. So what's the formula for accounting control fraud by a purchaser of these entities? Well, it's essentially the same thing. Instead of the first ingredient, instead of second ingredient, make really crappy loans, I purchase really crappy loans. And I report really nice yields. Now, can this keep going forever? Of course not. Can it keep going for a significant period, as in 8 to 10 years? Yes, if these things cluster and we hyperinflate the bubble. Because the saying in the trade is a rolling loan gathers no loss.
Yes, it's right.
Right. And so I can refinance the bad loans and I can hide the delinquencies for a decade. And again, we ran a real-world test of that. That showed that's precisely what you could do.
My only defense of neoclassical theory is, again, I think there was the potential expectation that this would not turn out as bad as it looked. But let me just again restate the idea. You're saying that if I'm Bear Stearns, Lehman, Merrill, Citi, et cetera, let's forget all the complexities of derivatives and CDOs and all this. I have a temptation to buy up really bad loans, put on my books an expected stream of earnings that probably and almost certainly will not materialize, but that's not known yet. So I put on my books that I have 30 years of wonderful payments coming in because the historic default rate is a fraction of what it will ultimately be, because that historic rate is predicated on a different set of people borrowing than are actually borrowing now. And in the short run, which could be a few years, I make really great paper profits, but I'm not really standing over a viable institution.
Right. And to quote someone who has been on your podcast, you also create plausible deniability. And so here's what he said.
Who are you quoting?
Charles Calamiris.
Yeah, go ahead.
Asset managers were placing someone else's money at risk.
Correct.
And earning huge salaries, bonuses, and management fees for being willing to pretend that these were reasonable investments. They may have reasoned that other competitors were behaving similarly and that they would be able to blame the collapse when it inevitably came on an unexpected shock. And then he says, derisively, who knew?
Yeah. Sarcasm.
So, Charles is, say, from pretty opposite side of the spectrum of me, and of course, has also run a bank and such, and was perhaps the leading economist in the world, urging internationally that you deregulate banks coming into this crisis. And Bo McAllister, who was at Pincus Warburg, here's what he said. By 2006 and early 2007, everyone thought we were headed to a cliff. The capital market experts I was listening to all thought the banks were going crazy, and that the terms of major loans being offered by the banks were nuttiness of epic proportions. And here are the numbers. After the FBI warned in September 2004 that there was an epidemic of mortgage fraud and predicted that it would cause a financial crisis if it were not contained, and after the industry, the mortgage lending industry, own anti-fraud experts issued the following 5 warnings in writing in 2006 to essentially every mortgage lender in the United States. 1, have you morons forgotten that we've done this before in 1990 and 1991, and it caused hundreds of millions of dollars in losses? 2, stated income loans are, and I quote, an open invitation to fraudsters. 3, the incidence of fraud in liar's loans is 90%, 90. 4, these loans deserve the phrase that the industry used behind closed doors to describe them. They are liar's loans. And 5, the banking regulatory agencies, and this is under Bush, are warning against making these loans. The industry massively expanded the number of liar's loans it made, such that by 2006, the best estimates are that 1/3 of all the loans made in that year were liar's loans. And remember liar's loans and subprime are not mutually exclusive categories. So by 2006, half of all the loans called subprime were also liar's loans. And now, what is the key difference? I explained to you we used to have rules on underwriting. In 1993, so this goes way back, under Clinton, they got rid of that as part of reinventing government. And examiners were instructed to refer to bankers as their clients. And rules were bad, so guidelines were in. And so there's now a guideline on underwriting. And a guideline is unenforceable. And so the absolute perfect thing for not creating a paper trail and no longer creating the dilemma about should I put false information in the loan file or should I take out honest information that shows I knew it was a bad loan. The absolute perfect device for fraud is the liar's loan because you don't document, you don't verify.
Right.
And so the paper trail is much easier for fraud in the current crisis. And then the other key is we eventually developed an incredibly effective means of dealing with the frauds in the form of criminal prosecutions, administrative enforcement actions, and civil cases, and convicted over 1,000 elites. These are not the little cases.
This is in the 80s.
Made in the 80s and made well over, just our agency, made well over 10,000 criminal referrals. Well over 10,000 criminal referrals.
Well, that was unpleasant for those people. So now they found a new way to live.
So our agency, our same agency in this crisis, the Office of Thrift Supervision, made 0 criminal referrals. And the OCC, the Office of the Comptroller of the Currency, depending on who you believe at the OCC, made either 0 or 3.
Yeah, that's
to which
0.
the Germans would say, dreimal ist kein Mal.
Which means?
Yeah, 3 is none.
Yeah, 3 is 0. So we're kind of out of time, but it's so this is so interesting. Let's try to finish with a conversation about what we agree on, what we don't agree on. So you and I might disagree about the behavior and the incentives that were in place. We might disagree about the strength of moral hazard. Where we agree is that by failing to prosecute actual fraud and by reducing the incentives for creditors to police risk-taking, we have certainly created an environment right now that is an unbelievably unhealthy situation. And I have to say, and you could correct me if I'm wrong, that when I'm watching a football game, which I do from time to time, and I see an ad for a credit card that offers this glorious rate of interest and all these special, wonderful things that come with it, and all kinds of prizes and rewards, I'm thinking, that reminds me of the savings and loan situation where you offer a really high rate of return to your depositors, and then you just take the money and you do some really dumb things with it. It doesn't really matter. What have we done in the last 4 years other than make this problem worse? And what should we have done? I'm giving you 5 to 10 minutes for this, Bill. I know you'd like another hour and a half. Maybe we'll revisit it in another podcast. But what do you think we have done to fraud incentives in the last 3 or 4 years, and what should we have done?
Well, I agree with you fundamentally that we have made the world much more criminogenic. So, I have a doctorate in criminology, and this is what I primarily research. Why do you have recurrent, intensifying financial crises brought on by these kinds of frauds? And it's a lot of the usual, the unintended consequences, but here are the unintended consequences of doing things like deregulation and modern executive compensation. And of course, I'm not unusual in this. Michael Jensen, the intellectual godfather of modern executive compensation, says that he's created a Frankenstein monster of creating perverse incentives. So, first, deal with the systemically dangerous institutions. And here, the administration can't even be honest. It calls them systemically important, like they deserve a gold star. But they are vastly beyond any efficiencies of scale. They are inefficient. We would make the world more efficient, and we would dramatically reduce systemic risk if we shrunk them to the size that they posed no systemic risk of global collapse. As long as they're this big, they are going to get away with murder. And worse, they will create a Gresham's dynamic. And this is something Akerlof warned about in his famous 1970 article on Lemons markets. Where cheaters prosper, bad ethics can drive good ethics out of the marketplace. So that's our fundamental task as financial regulators, is to make private market discipline more effective. By getting good information out and by removing the cheaters who create the perverse incentives to match what I'm doing or die. So that's what we want. We want, A, stop the systemically dangerous institutions from growing because we're making it worse right now by making them bigger. 2, we don't tell them how to shrink, but we give them 5 years to shrink. They can use their managerial judgment about how to do that. And 3, in the interim, you regulate them much more intensively. Executive compensation is broken. Everybody knows it's broken. Everybody knows that what really happens with executive compensation has nothing to do with what we teach about how to align the interests. In fact, it further misaligns it. And if you want the expert, it's Frank Raines at Fannie Mae, who said famously, if you wave enough money in front of folks, good people will do bad things. And that's exactly what happens, right? We can't, if you're Enron, think of how an Enron works. You can't send a memo to 3,000 Enron employees saying, you know what we'd like to do? We'd like to engage in pervasive accounting fraud because then we'll get rich in the interim and we'll walk away from the husk.
Because you go to
jail. But you can send the same message through your executive compensation, through what GE made famous as, rank and yank. All you have to do is add one message, and that message will get around the firm within seconds. The message is this: we don't care whether your reported income is real or not. If you create fictional reported income, and Enron did that pervasively, then we will make you rich. So you've got to fix executive compensation. You've got to restore the criminal referral process, which was essentially eliminated in the regulatory agencies. You have to stop this proposed settlement, at least as it's publicly reported, under which the Justice Department purportedly is going to give immunity from criminal prosecution for frauds in the process of making the loans, which is overwhelmingly where the frauds occurred, in vast dollar amounts. So those things you need to do. You need to reinstate the underwriting rule. Guidelines are the most useless regulatory activity in existence. They are the nattering state. People that need the rules will utterly ignore at all time your guidelines.
So let me give a political economy take on what you said. I'm going to add a piece to it, and then I'll let you have the last word. somewhere in the late 80s or early 1990s, there was a feeling among politicians that America's homeownership rate was not doing what it should be doing. It actually started in the 80s, in the early 80s, and there was political pressure and good intentions to try to get the homeownership rate up. There was, of course, also political pressure to allow people to expand their businesses in the financial sector. And this is what Bruce Yandel has called a bootlegger and Baptist situation, where you have good motives mingling with really pecuniary and not so good motives. But I think a lot of politicians managed to convince themselves in both parties that if they could loosen the spigot on money going into the housing sector, they would be able to increase the homeownership rate. And so the kind of things that you were talking about and that we've been talking about in this program for a long time, changes in underwriting, changes in requirements for Fannie and Freddie to purchase loans, changes in how investment banks structured themselves, all these things came together to allow an enormous sum of money to go into housing rather than elsewhere. A lot of people managed to convince themselves that was a good thing, either because they were getting extremely rich, and that includes the builders, along with the financial sector that was the greaser of the wheels, or because it was good for America to have more people owning homes than renting. And it blew up. It was an unsustainable strategy. It has created a hideous set of political and economic results. And it seems to me we've barely learned these lessons. What's your take?
I agree with most of the things you say, except that I think it had almost nothing to do with the crisis. So it's, I think, really naive to believe that any lender made loans because they thought it made politicians happy. Lenders made loans because it made individual lenders. I don't mean companies. I mean people.
Yeah.
Much, much wealthier. And they created those incentive structures not because they could care less about people. In fact, of course, the leading victims, and I would guess we both agree on this, have been the working class people, particularly minorities, who, after all, were put in vastly overpriced houses at the peak of the world's largest bubble, and have had a devastating loss of their net worth. So for us, we look, of course, as I'm sure
Bill,
you do.
But I got to interrupt you there. I think there are a lot of tragic individual stories, but many of the people who lost their homes never had any equity in them to start with. So their wealth was not wiped out. Their credit rating has been wiped out. Many of them didn't have much of a credit rating before, and it's a horrible thing to have to lose your house at the. There's an enormous emotional toll on folks, but it's not quite as bleak as you're making it out to be, right?
Oh, actually, I think the numbers will show that it is. You are quite right. That how much you put into a house matters. But I think you will find, even with folks with no down payment, which is sort of the extreme case.
Well, there's a lot of those during this period.
There were many that they actually make very substantial investments, and as a homeowner.
Yeah.
It ain't just your down payment in terms of your exposure.
Yeah.
So these folks, many of them are in states that allow deficiency judgments as well, and we've changed the bankruptcy laws to be much less consumer friendly, particularly on first homes as opposed to second homes. But let me come back to the more fundamental point. Like I'm sure we always are looking for natural experiments for what they can teach us. And liar's loans is something where no governmental entity encouraged them. In fact, even the Bush administration, banking regulators who were not fond of regulating, consistently disparaged those kinds of loans. And nobody ever required Fannie and Freddie to purchase a liar's loan. They chose to do so, and they increased it massively. From 2003 to 2006, the number of liar's loans increased by over 500%. So we think this actually is a story driven overwhelmingly by what we call accounting control fraud. And we think, no one much doubts that about the Enron era. And we think there's, pretty good consensus on the savings and loan crisis as well because of all the factual record. I mean, we had to go up against the best criminal defense lawyers in the world, and we got a 90% conviction rate. Plus, we satisfied the economists that looked. I quoted from the National Commission, which was run by economists, that concluded that at the typical large failure, fraud was invariably present. But if you go and read the economic literature on this crisis, you will find that Akerlof and Romer are cited, for example, in maybe generously 1 out of 100 articles that purport to discuss the causes of the crisis. And you will see that fraud is virtually never discussed as even a potential major contributor. And that is poor, and that is really the tribal taboo that still exists in economics against any serious consideration of the 5-letter F word, fraud.
My guest today has been William Black. Bill, thanks for being part of EconTalk.
Thank you so much for having me on.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.